Hello. Well, Jonathan's not with me today, unfortunately, so you just get to see me. And so rather than look at me, I'm going to share my screens with you and just kind of give you the nuts and bolts of what we're seeing heading into tomorrow. The flows of markets are actually really, really fairly positive. Even going into an event that apparently is as earth-shattering and important as the NVDA earnings report, which comes out tomorrow after the close. Today, of course, is Tuesday, August the 27th. It's about an hour after US markets have closed, and nothing crazy or earth-shattering, not a lot of volume today, which is pretty consistent with event volatility or the potential of event volatility, like an earnings report from a massively big company that takes up a lot of space in various indexes. So let me just share my screens real quick and kind of give you a picture of what I'm looking at. Um, that hopefully you'll be able to see this and it will make sense. And hopefully my technology won't be terrible here. At any rate, this is the S&P 5, or excuse me, this is NVIDIA. And what I'm looking at in NVIDIA right now is the fact that it is bullish trend. You hear me talk about trend a lot. That's nothing more than the rate of change of price, volume, and volatility over a time series of 3 months or more. And that's what this line is. And that gives us a good indication that institutions are still holding on to an upside possibility, turning into more of a probability the longer it maintains itself above that. And what I would really like to see is this white line, which is trade. Trade's just simply defined as the rate of change of price, volume, and volatility over a period of less than a month. And so that's that momentum line. Once that pops up above that trend, that becomes a very, very strong indicator that more likely than not, those levels are going to hold. So these blue lines are the intraday trading levels that are a function of taking a calculus of volatility and volume and price and just everything and pulling it all together and then looking at the flows of the market and gives us an indication of what the probability is that could occur for price movement. So these two blue lines become, I guess, more of a possibility than a probability, right? And anytime it's closer to the lower end of the probable range to the compared to the higher end of the probable range, which you see up here, it just tells us that more likely than not, it's creating a buying opportunity. What's going to happen after tomorrow's close and then into Thursday's trading? I have no idea. I'm not privy to the information that NVIDIA might be leaking out to some of their biggest hedge funds or biggest partners or people in that sphere. I really have no idea. The technicals are suggesting two things. One, it's above trade and trend, so that's bullish. It's signaling higher highs and higher lows, so that's bullish. However, the event itself could bring about a move that could take it all the way down into this area, roughly say 111 for NVIDIA. 111 for NVIDIA is still okay. That's still in the range of trend, and it would still remain bullish if it stayed in that range and then popped higher. And that's kind of been what they've been doing historically with their earnings reports. They go through maybe a little bit of a sell-off the day that they are ready to announce. Markets close. NVIDIA ends up slightly down. They blow away the data and blow away the numbers, and then the next day the stock goes straight up again. That's how it's been. Why is that important? It represents close to 7% of the S&P 500 at this point, or close to it. I'd have to update some of that data to get exact, but nevertheless, just know that it's a big portion of the S&P 500 in terms of how it can move the S&P. And so the S&P 500 right now is also in an interesting spot in that it is getting not overbought yet. For it to be overbought, I'd need to see some green bars like this, right? And that doesn't always mean that it's going to go down. As you can see here, this is price. It was overbought and it didn't come down, right? And so just because it's getting us into a condition that could be close to overbought does not mean that it's going to drop. Remember, we're still in a bull market. Bull market flows are still happening from CTAs, volatility control funds, hedge funds, things of that nature. And as that money comes in, it buoys the indexes like this. And so if we got to pull back tomorrow to 55.55 in the S&P, definitely a spot where we would more likely than not maybe add just a little bit of leverage to our more aggressive accounts. And if it came all the way down into this level, which is 55.10, we'd seriously consider about adding it up. And if it came all the way down to trend here at 54.54, I would definitely add it back to those more aggressive accounts. Our normal non-leveraged, what we call moderate to moderately conservative portfolios, I guess, are pretty fully allocated right now to U.S. equities and international equities, just as we continue to move in and through an economic cycle where two things are happening that I think are very, very, very important. Number one, monetary policy. And this is just a function of what we call M2. So you should be able to see this great big screen. M2 is just showing what the money supply is doing. And if the money supply is increasing, it makes it really, really hard for the equity market to get beat up that bad. 2022 was a tough year, of course, for markets, but look what was happening to money supply. It was declining. It was degrading. They were taking money out of the system, if you will, right? That's not happening to that extent anymore. It's been accelerating, as you can see there. The other thing that's incredibly important is something called VIX term structure. This is for volatility. Anytime we have VX1 below VX2, it just simply means that this is the VIX1 contract planning to expire, currently ready to expire September 17th. VX2 contract expiration is October 15th. This is a normal relationship. VX1 is lower than VX2. Now, why is that important? Well, anytime VX1 gets above VX2, that's what's called backwardation. Backwardation in the futures contracts and of VIX is indicating there's a real problem somewhere that more likely than not is going to result in or manifest in lower prices for the stock market. In fact, if I were to go back and I'm not going to do this because I would bore you to tears, but if I would go back and show you the day that the VIX term structure went into backwardation, in other words, VIX1 went above VIX2, not like what you're seeing now. VIX1 is below VIX2, but if it were way up in here, above VIX2, if I went back and showed you every single instance that VX1 was higher than VX2, you would see a situation where the stock market ended up going through some type of drawdown, or in some cases, even a full-on drop, bear market, or collapse every time. So watching VX1 and VX2 for us is very important. This is what we call contango. Contango is normal. Backwardation is backward. It's not normal. So when we see that happen, we start to consider backing up and protecting more than not. That becomes even more valuable and even more important if we're in a macro cycle that is more risk off than risk on. And again, even more and more important that if we are already in a trending bear market. So none of those things are in play at this time, at least yet. It changes every day. So we watch it every day throughout the day just to try and give us an indication of where risks might be creeping in. And this is very steep. And so nothing is pointing, at least to us, as, oh, that's a serious problem. We should watch out for that. So those are the things that we're looking at right now for the S&P 500. We're looking at this first level of 55.55, the next level of 55.10, and the level below that at 54.54. Those would all be three decent spots to consider increasing the degree of risk that we are willing to take. But even right now, the flows that are coming into U.S. markets, especially via the options market, are showing to be very, very strong. And so therefore, we're pretty well allocated. Bonds, I'm going to show you this just real quickly. This is the 20-year yield. This is the 10-year yield. And what it's showing me is what I've been talking about in my morning emails. Both of those longer dated yields are showing bearish trend, which just means that it is more likely than not that we see a longer term drop in interest rates or longer term cycling down of interest rates as we kind of progress through this current economic cycle. And you can see that on a longer time scale, this is weekly. So each one of these bars represents 1 week. You can see it broke through this longer dated trend level. Again, price, volume, and volatility, rate of change over a period of 3 years or more. It's much, much different in terms of that kind of scenario. However, this thing here and this thing here tells me that it would not surprise me to see price, in this case, yield, go from the current 3.83% up to this level here, which is 4.18. Now, am I expecting it to happen? No, but the possibility is definitely there based on the way that these other indicators are playing out. Same is true for the 20-year Treasury. And so you get some backing and filling, you get some up and down, and it creates an environment with yields where, again, the economic cycle is such right now where it is more probable than not that we continue to see a decline in interest rates, not an increase. But we can have these moments where interest rates on the longer side of the yield curve go up a little bit. And it's just that typical backing and filling that you get within a cycle where bonds are bullish. Interest rates dropping makes bonds bullish. And when bonds are bullish, well, then that makes yields bearish. So my expectation is over the next several months, we're going to continue to see a couple of things. Number one, we're going to see the Fed cut rates more likely than not in September. How much? Don't know. Some are calling for 25 basis points. We've seen markets planning or expecting up to 50 basis points. Who knows, right? It's anybody's guess. With inside that, though, we continue to be within a bullish confine of U.S. equity markets on the S&P. Primarily, it is a much stronger index right now than some of the other indexes, and a lot of that has to do just with names that would be more cyclical in nature or consumer oriented in nature. Think of names like maybe Walmart or Target, things of that nature, right? Which their sales and earnings numbers have been really pretty strong. So all that is looking very, very normal. The correlation grid, and I won't show you this because it'll make you googly-eyed, but the correlation grid's valuable in that what we want to look for are correlations that start to shift. And when I say correlations, I'm talking about stocks to bonds, stocks to currency, stocks to yields, stocks to gold, so on and so forth, right? And then vice versa. And right now, they're very strongly positive pretty well across the board. In other words, there's a 0.81 correlation with the S&P 500 in gold. There's a 0.92 correlation with the S&P 500 and the Russell 2000, a little bit higher with the NASDAQ 100, a 0.7 correlation with bonds, longer dated bonds. Proxy for that is symbol TLT if you're interested in looking it up. But when you have these correlations that are running the same, the next thing I want to look at is the US dollar and ask myself, is it positively correlated as well? And it's not. Right now, the correlation with the US dollar across all those elements or all those indexes or investments that I just mentioned are negatively correlated anywhere from 0.7 all the way to 0.96. And so when you have that kind of a correlation scenario, the dollar movement becomes very, very important. And when you have a negative correlation with the US dollar, what we have to look for then is to ask ourselves, okay, is the US dollar bullish or bearish? Well, here's a picture of the US dollar. And as you can see, the US dollar is bearish trend, signaling lower highs and lower lows. And so that's interesting. Now it is oversold. So when you get an oversold condition within a bearish environment, it can go one of two ways. You can get a short pop up to the lowest range, which would be right here at about 101.75. This is DXY, by the way. This is the US dollar index. Or it can crash. Now, a dollar crashing from here would move both stocks and bonds higher by a fair amount. And so I'm not in either camp right now because I'm not seeing an indication that, oh goodness, we're in a flat out scenario where the US dollar is just going to collapse. We're not seeing that. And I don't think the US government wants that to happen. And so, yes, there is some, dare I say, manipulation that goes on within the hallowed halls of the Fed to the Treasury. Yeah, there's always a little bit of monkey business in that environment. But nevertheless, what the US dollar index is telling us is it's trading in a bearish trend. Again, rate of change, price, volume, and volatility for a period of time greater than 3 months. And so it's bearish trend, it's bearish trade. So the momentum players are pushing down on the US dollar, not up. And so as that happens, as long as we see these negative correlations along with stocks and bonds, if the dollar continues to go down, as an investment manager, I really don't care. In fact, I would prefer that because it creates a tailwind behind the U.S. stocks and U.S. bonds scenario, of which we are large owners of right now. And so having a negative correlation with the U.S. dollar and those elements is okay from an investment standpoint. Is it great to see the value of the US dollar go down in terms of purchasing power? No, no, it isn't. But this is not abnormal for what you would get at this part of the cycle in an environment where the markets are expecting the Federal Reserve to cut interest rates, right? Remember, if they cut interest rates, they're just paying less on the value of that dollar. So if a citizen or a foreign country were to hold US dollars, and they cut what they were getting paid for holding those US dollars, i.e., interest, well, then all of a sudden the demand for those dollars might not be as much. There's a lot, that's very simplified. There are a lot of other dynamics that go into the supply and demand of US dollars. Yes, there's an awful lot of emerging market debt that has to be paid back in US dollars, and they don't have enough of them. So, there's that dynamic that acts as a tailwind behind the US dollar versus as a headwind. So am I in the camp that the US dollar is just going to get collapsed on, go away, and cause all of us to have a crazy amount of hyperinflation? No, I'm not in that camp. Am I in the camp where we continue to see this slow march lower until it stops? Yes. How do we know when it stops? Well, it'll stop when it stops, but the first indication will be that it will start to move itself higher. It will recapture its trade level, which is that, again, price, volume, and volatility rate of change over a period of less than a month. The momentum players will start to kick in, buying US dollars. It then moves into bullish trend. And at that point, the decline in the US dollar would probably be over. When is that going to happen? No idea. Year to date, the US dollar is down 0.8%. Over the last month, it's down 3.6%. Over the last 3 months, it's down 3.9%. So as you can see, it's just trending lower. And as long as those negative correlations continue to stick in place with the US dollar to stocks and bonds, there's not a huge aspect of negativity that, at least on the surface, or underneath the surface, from what we can see from volatility regimens and things of that nature, that would cause the US stock market to have all sorts of problems. One other thing that I think is important to view, and I'll share my screen for this last thing, and then I will get out of your hair, is junk bonds. Now, junk bonds are, well, they're what they sound like. They're bonds that are floated to institutions or businesses or companies that have less than stellar credit. And so when that happens, these companies have to pay a much, much higher rate of interest to maintain those loans. And in economic cycles where we see massive amounts of weakness, we see high yield bonds really getting clipped and going down, not just a little, but a lot. And I'll show you what I mean. I'm going to show you a weekly chart, and I'm going to back this up all the way into 2022, the last time we had a real massive US stock market drop. And look at what happened to price of junk bonds. I mean, junk bonds in 2022 went from 87 bucks a share all the way to its low down to 70 bucks a share, right? That's a big drop, right? And that was telling us early, even if I backed up into 2021, high yield bonds were having a problem. And so it was an early indication that, hey, there's a problem economically happening right now. Well, look at it now. Junk bonds just keep kind of slowly marching themselves higher, staying above trade. Again, rate of change, price, volume, and volatility, less than a month, staying above trend. Whenever you have those conditions in an asset class where it just comes down, bumps off a trade, moves higher, bumps off a trade, moves higher, that's very bullish. It's a bullish trend signaling higher highs, right? And so when you have those kinds of things happening inside something like a high yield bond that more highly correlates to stocks, it moves along with the same kinds of economic conditions that you might that you might be able to deal with stocks. You kind of put them together and say, oh, look at it's yeah, that's a thing. So not a problem in high yield bond land. Okay, that's it. I don't want to bore you anymore. I just wanted to give you some basic things to consider and think about or uh, watch, I guess. Just know that I'm watching it and I watch it every day, all the time US markets are open. Jonathan does as well, along with me. He couldn't make today's podcast, but definitely we'll get him back in again here after NVIDIA earnings, because I'm sure there'll be some fun things to talk about with how the action and markets move then. So until then, if you have any questions or if you want to chat, reach out to me, Chris at careformywealth.com. Shoot me an email, which is, again, Chris at careformywealth.com, or give me a call, 608 354 1977. That's my direct line. If you want to use toll free, you can do that. 866 596 9886. Okay, thanks so much. Hope everything's well. Have an awesome day. God bless. We'll see you soon.